Hey everybody, welcome back to the channel. So today we're going to answer a viewer's question that deals with this. We've heard about safe withdrawal rates. We're probably all familiar with the 4% rule. But in that 4% rule, Bill Bingen made some assumptions about our investment portfolio. We'll talk about that. But he made some assumptions in terms of how much we have in stocks and how much we have in bonds. And it raises the question, well, how do we figure out a reasonable safe withdrawal rate for our specific investment portfolio? Maybe you're 100% stocks, or maybe you don't have much in stocks at all. You're predominantly bonds. Does the 4% rule still work? How do we kind of customize a safe withdrawal rate to meet our very specific set of circumstances? So that's what we're going to try to do today. It came up in the live Q&A. I do a live Q&A every other Monday. We had one just a couple of days ago, and a viewer had asked a question that I didn't get to, and it was basically this. Hey, I've got a 30-70 allocation, so 30% stocks, 70% bonds. How does a person determine a withdrawal rate for this allocation? That was their question. I think it's a very good one. And so what we're going to do is look at two different tools you can use to do that, how that might look. And honestly, it's kind of, I think, easier than you might think. So remember, as we look at these tools, Bill Bingen in the 4% rule, what he found was you need stocks somewhere in the 50 to 75% range, the rest in bonds. He used intermediate term U.S. Treasuries for his bonds. His stocks were basically the S&P 500. What he said was if you go significantly above 75% stocks or significantly below 50% in stocks, the safe withdrawal rate starts to go down a bit. Now, it doesn't fall dramatically to something like 1%, but it does go below 4%, down into the threes. And the reason is, like with 100% stocks, what if we have a 1929 crash where stocks were down 91% in 3 years? Maybe it won't happen again in our lifetime, but that's a risk. And so you can run into that kind of problem with too much in stocks. And if you don't have enough in stocks, just bonds, it's really hard to outrun inflation. And after bad markets, when the markets recover, you don't enjoy that recovery as much if you don't have enough in stocks. So that's sort of the background. But let's look at a portfolio of 30% stocks and 70% bonds. How would we figure out maybe a reasonable approach? So here we go. The first tool that I like is Fial. We've looked at this many times. It's a free tool. And what I've done, I've got a 30-year retirement. Of course, you may be planning for a longer or shorter one, but I've got the sort of the, I guess, traditional 30-year retirement, $1 million portfolio. And I put, in terms of asset allocation for now, 65% stocks, 35% bonds. This would fall well within Bill Bingen's 4% rule. Important, the only fees I'm reflecting are the fees you might pay on an index fund kind of portfolio. I don't have any advisor fees. I just did a video, you may have seen it. If you have advisor fees, that's going to bring down your wealth and your safe withdrawal rate considerably. But I'm assuming only index fund fees. And we can see that you basically, but we'll call it a 97% chance of success. Bill Bingen would have actually shown this as 100%. As I've mentioned before, I think Fial uses slightly different data sets. But basically, your money will last at least 30 years. That's what success means here. The only time it didn't, I'm sure this will be the mid to late 60s. Yeah, so the 30-year periods that began in 65, 66, 68, and 69 ran out of money. But other than that, this succeeded almost 97% of the time. Now, what does that look like if we go to an allocation of 30% stocks and 70% bonds? Well, it goes down a fair amount, right? It goes down to 97, from 97% roughly to 89.5%. And here I think it's important to get an idea of when this 30-70 portfolio failed, because it will give you an idea of the kind of economic circumstances that could cause this portfolio, assuming, again, a 4% withdrawal rate. I got $40,000 withdrawal the first year on $1 million portfolio. That's how I get 4%, and I am adjusting it for inflation with this checkbox here. So where did it fail? Whoops, we can come back down here. And of course, it fails in those 4 periods we saw before, but it also fails in 4 additional periods. And what's interesting about this is, you can say, well, why did these 62, 3, 4, and 7, why did they succeed when we had a traditional portfolio and these failed? And I think part of the answer is these were far back enough in time that the bad times didn't start right away. You got through your some period of your retirement before the really heavy inflation of the 70s kicked in, and you had just enough time before that what some would call it a sequence of returns risk, before the bad markets and inflation kicked in, that it allowed your portfolio to do okay. But when we remove a lot of the stocks from the portfolio, only go 30% stocks, they just don't get that initial boost that they need to get through the 70s. So they fail. And then we can see sort of end of depression, into I guess World War II periods failed. Some bad markets in the late 30s, so they failed there. And I guess some that 1899 failed. But the point is, we've gone down now to a success rate of about 90%. Now, what do we make of that? Does that mean the 4% rule won't work? Well, for many people, you might say, I'm okay with that, Rob. 90% success rate, again, based on historical data. I'm okay with that. And if it turns out, today is like the mid 1960s and I'm going to run out of money, I'll just have to cut back, and I'm okay with that. Others might say, no, I'm not comfortable doing that. And so going back to the table, you can simply decrease your initial withdrawal amount until you get to a success rate you're comfortable with. So let's just put in 38,000. Oops, not 28, 38. That takes us to 95. Maybe that's where you're comfortable. 37 takes us to even higher than before. So, you could be looking at a 3.7% initial withdrawal rate, maybe a 3.8. So that's how that first tool works and how you might use it to try to get a sense of your individual safe withdrawal rate based on your specific asset allocation. Now, there's another tool that I think is far more robust, but it takes some effort, and it's a paid tool, and it's one we've talked about before. It's New Retirement. This is a demo account that I've shown you many times. And so the way New Retirement works is fundamentally different than FI Calc. So FI Calc is using historical data. And I think it's really important to look at your retirement plan through the lens of historical data. I think it gives us a lot of very useful information. But as we all know, history won't repeat itself. I guess it rhymes, right? As the saying goes. But the downside to relying just on historical data is we could experience a future that isn't reflected in the past yet. Well, what New Retirement does is it uses Monte Carlo simulations, which allows us to look at possible futures that we've not experienced in the past. So I think they're both important. I think they're both useful. I'm going to change the assumptions on this. I'll bring it to optimistic. Okay, so how do we do that in New Retirement? Well, New Retirement does not ask you for your asset allocation. We can go into accounts and we'll look at this $500,000 traditional IRA. If we want to edit it, you can see there's nowhere in here to put your asset allocation. That's not how New Retirement works. Instead, you can put your optimistic and pessimistic rate of return. All right, how do we think about that? Well, we can go to a couple of resources to figure out what this would look like. In this case, for a portfolio of 30% stocks and 70% bonds. The first place we can go is Vanguard. This is an article they have. I'll leave a link to it below the video. They're looking at data from 1926 to 2022. It starts here with 100% bonds. This is 30% bonds right here. So we can see the average return on a 30-70 portfolio. They call it 70-30 because they're putting the bonds first. But for this portfolio is 7%. So what I would do, I would make 7% my optimistic rate of return, even though 7% is average. I always like to take a somewhat conservative viewpoint. And so I view that as sort of the optimistic. I'm going to set the pessimistic, particularly with a bond-heavy portfolio, probably at my pessimistic inflation assumption, or maybe even a tad lower. So let me save this for a minute. If we go down to assumptions, so my pessimistic general rate of inflation is 5%. So if I go back to my accounts, I'm just going to do this for the one we've been looking at. 5%, I might even, because it's so heavy in bonds, I might go 4%. Probably wouldn't go lower than that, maybe 4.5%, but let's put it 4%. And now, of course, I would do the same thing if that portfolio allocation was the same across all of my accounts. then I would do the same thing across all of my accounts. And then once you do that and you have all your expense data in here and everything else about your planned retirement, you can go to overview and it will give you your chance of success. Now I've got it set to optimistic. If we go to average, it's going to go down. I tend to spend most of my time in the average assumption. So if we go back to this account right here, the average comes out to 5.5%. I think that's a good conservative approach. And you can also come down to explorers and you can run a more robust Monte Carlo simulation here, where you vary not only the investment returns, you can vary general inflation, medical inflation. If you're in retirement, you may not need to worry about wage growth. If you're still working, maybe you want to vary that as well, and you can see more data. Now, the other thing I'll mention, we looked at this Vanguard article to come up with this 7%. You can also use Portfolio Visualizer. For tools, I would use their asset class allocation rather than their portfolio, unless you use the paid version. If you use the free version, which is what I've got here, you're limited to 10 years data on the portfolio tool, but with asset allocation, you get more data, and I think it's all you need. So what I did, I just started with a 65-35 sort of, I'll call that a Bill Bengen portfolio. And you can see the compound annual growth rate right here is 9%. So what if we come here and we put in this 30-70 portfolio? So 30% stocks, 70% bonds. And I'm just using two basic asset classes. You could add more if you have small cap or international or whatever. But we'll just leave it simple. Analyze the portfolios. And if we come down here, we can see this shows us 7%. So pretty much what Vanguard showed us. Vanguard's data went back to 1926. This data is more recent, 1987. I kind of like to look at both, but it's the same thing, 7%. So I'd go back to new retirement and I would think, okay, I like my assumptions here. Again, I'll show it to you where I've got 7% optimistic, 4% pessimistic. I'm going to probably spend most of my time assuming average, which would put this at 5.5. But I'll stress test it. I'll look at pessimistic, and maybe if I'm just feeling down, I need to feel better for the day, I might just go to optimistic and look at that. But that gives you the rough idea. You can use FI Calc to get sort of a very quick look at what your safe withdrawal rate would look like for your specific asset allocation. And then I think for a more robust kind of analysis, something like new retirement, you can do that as I've walked through as well. And yeah, you can customize your withdrawal plan to your specific asset allocation. So there you go. Hope you find this helpful. If you have any questions, leave them in the comments below. And until next time, remember, the best thing money can buy is financial freedom.